After the 2020 pandemic, with loose monetary policies and the shifting of supply chains, we have witnessed a significant surge in prices. In this context, wealth has been quietly redistributed across society. Gold, as a key indicator of wealth, has played an important role in this redistribution. As of September 2024, gold prices have been steadily rising. But has this current surge reached its peak, or is there more room for further increases? What is the underlying market logic driving these movements? In the following discussion, I will explore these questions from a different perspective. Gold, unlike many other assets, does not generate cash flow, which often makes it challenging to value. However, by examining historical gold price patterns and the corresponding economic environments, we can uncover hidden valuation principles in the market. I will discuss two valuation models that I believe offer effective insights into gold prices and share a simple, practical method for gauging whether gold is over or undervalued. Of course, the future is inherently uncertain, and markets may not always follow these logical patterns. Nevertheless, I hope these frameworks can provide a fresh perspective on gold investment. To fully grasp the logic behind gold's valuation, it is essential to first understand the fundamentals of the gold market. I will briefly outline the key players in the gold market, the changes in gold holdings by major central banks, and the views of prominent investors like Warren Buffett and Ray Dalio on gold. Afterward, I will evaluate gold's true potential as a store of value before introducing valuation models that I believe align with market trends. I will show how these models can help assess gold's price levels. Disclaimer: the gold prices and trends presented in this video do not represent future gold prices or trends. All models are provided for reference purposes only and do not constitute investment advice, recommendations, or offers. No liability will be assumed for any losses resulting therefrom. Gold investments carry risk. Please conduct independent analysis and invest prudently. Who is buying gold? According to the World Gold Council's 2023 report, the Earth holds approximately 270,000 metric tons of gold, of which 210,000 tons have already been mined, leaving less than 60,000 tons unmined. All the gold ever mined by humanity could fill 2.8 Olympic-sized swimming pools. Of the gold that has been mined, nearly half is used for jewelry, while over 1/5 is held as investment in the form of gold bars and coins. Additionally, 17% of the world's gold is held by central banks as reserves. In 2023, global gold demand was primarily driven by 2,168 tons used for jewelry, representing 44.2% of total supply, and central bank purchases amounting to 1,037.4 tons, or 21.2% of total supply. The remainder was mainly for investment purposes, such as bars and coins. Given the annual production of 3,644.4 tons of gold in 2023, the estimated 60,000 tons of unmined gold could be fully extracted in just 16 years. Changes in central bank gold holdings. Having reviewed the composition of gold buyers globally, we see that nearly 40% of gold consumption comes from jewelry, with individual consumers as the main purchasers. The other two major buyers are central banks and gold investors. Central bank gold purchases, in particular, have attracted significant market attention. As of 2023, the top 6 central banks holding the most gold are the US, Germany, Italy, France, Russia, and China. Before and after the pandemic, central banks of China, India, Japan, Russia, and Turkey increased their gold reserves significantly, while the top 4 holders, the US, Germany, Italy, and France, saw little change in their reserves. This is because the US dollar and the euro remain the primary reserve currencies for other nations. The main drivers behind the recent central banks' gold demand have been the central banks from non-reserve currency nations. This trend mirrors the actions of Western European countries before the collapse of the Bretton Woods system in 1971. In the 1960s, the world was still under a gold standard tied to the US dollar, but the oversupply of dollars caused dissatisfaction among countries like France and Germany, which held large dollar reserves. These countries began converting their dollar holdings into gold, eventually leading to the decoupling of the dollar from gold. Buffett and Dalio's views on gold. Let's take a look at the perspectives of two influential figures in the investment world, Warren Buffett of Berkshire Hathaway and Ray Dalio of Bridgewater Associates, regarding gold. Buffett famously said that gold is dug out of the ground, melted down into bars, and then buried again, with people paid to guard it. He noted, gold has no utility. On the other hand, Dalio believes that if an investor doesn't own gold, they neither understand history nor economics. Buffett's view on gold is rooted in his investment philosophy, which favors assets that generate cash flow and compound returns over time. He argues that gold produces no income, dividends, or any form of cash flow, and it doesn't contribute directly to the economy. In Buffett's eyes, gold is a non-productive asset, and its value hinges primarily on the belief that someone will buy it at a higher price in the future. Dalio's perspective stands in sharp contrast. In his book, The Changing World Order, Dalio analyzes the rise and fall of global powers throughout history and identifies patterns. He observes that when new empires rise, the currencies of declining empires tend to devalue, eroding purchasing power. During these transitional periods between old and emerging powers, gold, unlike depreciating fiat currencies, has historically maintained its value and acted as a reliable store of wealth. In major global crises and wars, fiat currencies have often lost significant value relative to gold. According to Dalio, during these periods of world order shifts, gold consistently protects against the depreciation of fiat currencies. Looking at Dalio's macro-historical perspective, Buffett's investment experience has occurred during the upward phase of the economic cycle. Buffett himself has said he was fortunate to be born in a prosperous America rather than in an underdeveloped region, and that he benefited from America's post-war economic boom. However, if the U.S., the world's leading power, begins to decline or stagnate, Dalio's view suggests that gold could serve as a hedge against the weakening of the U.S. dollar. When comparing Buffett and Dalio's views, it becomes clear that Buffett views gold in relation to capital, focusing on returns and the compounding effect of productive assets. Dalio, on the other hand, compares gold to currency, paying attention to historical cycles of power shifts and the inflation risks caused by excessive money printing. While both capital and currency relate to wealth, they are fundamentally different. In times of societal stability, capital grows and creates wealth, whereas currency's primary function is as a medium of exchange, whose purchasing power fluctuates based on economic conditions. Clearly, Buffett and Dalio are looking at gold from different time horizons and viewpoints, and neither view is necessarily superior to the other. So, do you lean more toward Buffett or Dalio's perspective? Can gold preserve wealth? Whenever global uncertainty or market panic arises, capital tends to flow into gold and bonds, often referred to as safe havens. This behavior mirrors how, in times of historical turmoil, people would sell off real estate and convert assets into gold. Investors view gold as a vessel of wealth, believing it can protect against inflation over the long term. But does gold truly preserve wealth, or to what extent can it serve this function? We can make a rough assessment by comparing historical gold price movements with inflation rates. In August 1971, U.S. President Nixon announced the end of the gold standard, decoupling the dollar from gold. Since then, gold prices have been determined by market forces. From August 1971 to April 2024, the U.S. Consumer Price Index, CPI, increased by 7.7 times, while gold prices surged nearly 60-fold during the same period. However, it's important to note that part of gold's sharp rise was due to its initially low price when the dollar was first decoupled from gold. If we instead measure from December 1991, when gold prices were more stable, to April 2024, inflation increased 2.3 times, while gold prices grew by over 6 times. Over the long term, gold has indeed shown the ability to preserve wealth and even appreciate in value. However, it's important to note that if you purchase gold during a price peak, there may be periods where gold does not keep up with inflation. This leads us to the next point. How can we determine whether gold prices are high or low? Additionally, if we compare the performance of the S&P 500 over the same period, the index has risen by more than 12 times. While gold has often outpaced inflation, It has not kept up with the growth of the S&P 500 to date. Valuation logic of gold. Next, I'll explore how the market values gold under different economic conditions. Gold prices fluctuate as the economic environment and monetary policies change. By observing these fluctuations, we can see that gold often correlates with economic indicators such as GDP and interest rates. Based on these correlations, I have summarized a GDP equivalent model for gold prices and a correlation model that connects gold with interest rates and other economic indicators. In the early 1980s, as oil prices surged, G7 countries raised interest rates to combat rising inflation. This led to gold's first major price peak after the breakdown of the Bretton Woods system in 1971. If we use U.S. GDP and gold prices post-Bretton Woods as a reference, we can derive the U.S. GDP equivalent price of gold. During this period of high inflation, the gold price exceeded the GDP equivalent price curve significantly, showing that despite the Federal Reserve's high interest rates, people were eager to buy gold to protect against inflation. In the 1970s and 1980s, gold prices generally fluctuated around the U.S. GDP equivalent price. The Fed's high interest rate policy in the early 1980s caused the yield on U.S. 10-year Treasuries to exceed 15%. Once inflation was under control, long-term bonds, which provided stable cash flows, became more appealing to the market than gold, which led to gold's lost 2 decades. By the late 1990s, under President Clinton's second term, the U.S. achieved fiscal discipline and recorded substantial budget surpluses, strengthening the dollar and pushing gold prices lower. Gold prices fell far below the U.S. GDP equivalent price during this time, as low unemployment and a strong economy made gold less attractive. However, following the bursting of the dot-com bubble in 2000 and the September 11th attacks, the pricing logic for gold shifted significantly. During President George W. Bush's administration, the U.S. fiscal budget rapidly shifted from surplus to deficit, and the Federal Reserve significantly lowered interest rates to stimulate the economy. From 2001 to the 2008 financial crisis, gold prices surged. After the financial crisis, the Fed took unprecedented steps, slashing interest rates to near zero, and gold prices continued to rise, hitting their second peak at the U.S. GDP equivalent price. Unlike the first peak, which was a response to actual inflation, this second peak reflected market expectations of future inflation driven by the Fed's quantitative easing policies. Since there wasn't significant actual inflation during this period, gold's second peak didn't far exceed the GDP equivalent price as it had during the first peak, but rather returned to it. Another important event before this gold price surge was China's accession to the World Trade Organization, WTO, on December 11th, 2001. This event rapidly integrated China's economy with the global market, boosting GDP growth worldwide and leading to a massive increase in China's foreign exchange reserves. The key economic features of this period were rising U.S. fiscal deficits, the Fed's accommodative monetary policy post-crisis, and China's large-scale gold purchases as foreign reserves. These factors made gold prices particularly strong. Gold prices began to retreat after reaching their second peak in 2013. I will later introduce the interest rate correlation model to explain the market logic during this period. From the second peak in 2011 to September 2024, gold prices have generally remained below the U.S. GDP equivalent price. As of September 2024, gold prices have surpassed $2,600 and are approaching the U.S. GDP equivalent price of $2,900. If we reference the second peak from 2011, this price range could mark the third stage peak for gold prices. Before and after the pandemic, central banks in China, India, Japan, and other countries significantly increased their gold reserves, providing strong support for gold prices. Could the global GDP equivalent model for gold reflect the demand from these central banks? As shown in the graph, global GDP equivalent gold prices continuously exceed the U.S. GDP equivalent prices after 2004. Based on the World Bank's 2023 global GDP figures, the global GDP equivalent model values gold at around $3,100. Given the ongoing de-dollarization trends in developing countries, global GDP equivalent prices could become a long-term benchmark for gold. Historically, gold has only reached global GDP equivalent prices once before, in the early 1980s. We see that the first and second peaks in gold prices were both related to high inflation. Gold's price increases were proportional to inflation intensity, and excessive money printing was one of the main causes of high inflation. Next, I will introduce the U.S. Monetary Supply (M2) equivalent model, using M2 as an indicator to explore the relationship between the U.S. money supply and gold prices. Using the same method as the U.S. GDP model, this M2 MICE equivalent model shows that gold prices during the second peak fluctuated between the U.S. GDP and M2 equivalent prices. After the pandemic in 2020, the Fed's aggressive quantitative easing led to a rapid increase in M2. As of September 2024, the M2 equivalent price stands at around $3,700, significantly higher than both the US and global GDP equivalent prices. If inflation remains under control, this level could mark the long-term peak for gold prices. The chart summarizes these three models, showing potential future gold price ranges: U.S. GDP equivalent prices for short-term peaks, global GDP equivalent prices for long-term averages, and U.S. M2 equivalent prices as the long-term peak if inflation remains moderate. Now, I'll introduce another important valuation model, the gold and interest rate correlation model. After gold reached its second peak in 2011, the S&P 500 gradually surpassed its pre-2008 financial crisis high, reflecting the recovery of the U.S. economy after nearly 5 years of near-zero interest rates. Gold prices began to fall, but did not collapse, instead stabilizing within a valuation range. This period lasted from 2013 to 2022, 10 years in total. During this time, the Fed first raised interest rates in 2016, then lowered them back to near zero after the 2020 pandemic. Gold prices showed a strong correlation with interest rates and other economic indicators during this period. Using regression analysis, I developed a gold interest rate correlation model, which, unlike the GDP equivalent model that tracks overall trends, can follow real-time gold prices based on interest rates and economic indicators. Between 2013 and 2022, the gold interest rate correlation model closely matched actual gold prices. This means that if given the necessary interest rate and economic data, this model can provide near-market gold prices. Conversely, if gold prices significantly deviate from this model, it signals a major shift in market logic, offering an indicator of changing market dynamics. I've created a Google Sheet with more detailed explanations of the GDP, M2, equivalent models, and the interest rate correlation model, along with a comparison of these models against actual gold price trends. You can input GDP and other economic indicators to obtain reference prices for different gold valuation models. Interested readers can check out the details via the Patreon link below. From 2023 onward, gold pricing logic has fundamentally shifted. Gold prices have significantly deviated from the interest rate correlation model, mirroring the price pattern seen after 2008. Initially, gold and the correlation model aligned closely, but then gold prices moved towards the U.S. GDP equivalent price. This reflects a loss of market confidence in the U.S. dollar and a renewed reliance on gold's inflation hedging properties. After the pandemic, U.S. debt levels reached record highs, surpassing 120% of GDP. Central banks in Asia, including China, India, and Japan, significantly increased their gold reserves, echoing the situation before the breakdown of the Bretton Woods system in 1971. Back then, the U.S. adopted a loose monetary policy to fund the Vietnam War and social welfare programs, which led European countries to abandon the fixed exchange rate system with the dollar, converting their dollar reserves into gold and forcing the U.S. to end the dollar-gold peg. Similarly, post-pandemic, the U.S. adopted an ultra-loose monetary policy, significantly increasing debt and liquidity. The resulting high inflation forced the Fed to raise interest rates rapidly, leading to a sharp decline in U.S. bond prices. Foreign central banks holding large amounts of U.S. debt faced substantial paper losses. The shortage of overseas dollars, combined with these losses, has severely undermined confidence in the dollar system, prompting Asian countries with large dollar reserves to increase their gold reserves, just as Europe did in the 1960s. This central bank and public buying behavior has effectively supported gold prices. Today's U.S. economy combines characteristics of the early 1980s, high inflation and high interest rates, with the quantitative easing environment of the post-2008 financial crisis. These factors provide strong support for gold prices. As of September 2024, gold has surpassed $2,600, approaching the U.S. GDP equivalent price. However, if U.S. inflation is effectively controlled and long-term bond yields exceed the inflation rate, gold prices could peak and return to the interest rate correlation model's price range. Another possibility is that as BRICS nations continue to buy gold, its price could fluctuate around the global GDP equivalent level in the long run. While we can't predict whether current monetary policies will successfully curb inflation, it's clear that, given the scale of U.S. fiscal deficits, it is unlikely the U.S. will return to the budget surplus of pre-2001. This means long-term bond yields will likely not exceed inflation by much, making a repeat of gold's lost decades. Postscript 2001, a watershed year in world history that changed the fate of two nations. This concludes my analysis of the historical trends in gold prices. Now I'd like to share some broader reflections. Over the past 30 years, 2001 stands out as a historically significant year. Not because of 2001, A Space Odyssey by Sir Arthur Clarke, but because the global economy and the logic behind gold pricing underwent major shifts starting that year. Two monumental events in world history occurred: the September 11th terrorist attacks in the United States, and 3 months later, on December 11th, China officially joined the World Trade Organization, WTO. The War on Terror entangled the U.S. in Afghanistan for 20 years, once again reinforcing Afghanistan's reputation as the graveyard of empires. It also transformed America's financial position from a surplus to unsustainable deficits. From that point on, the U.S. government had to rely on debt issuance and money printing to sustain its economy. Fortunately for the U.S., it coincided with the economic rise of China, India, and Southeast Asia. These developing nations exchanged cheap goods for U.S. dollars, preventing the kind of rampant inflation that followed the Vietnam War. These countries not only developed their economies during this period, but also indirectly financed America's war in Afghanistan. China's entry into the WTO made it an indispensable part of the global supply chain, and its vast market began reshaping the world economy. For gold, 2001 was also a pivotal moment. In the years before 2001, the U.S. had a relatively stable fiscal situation, leading to a weaker gold market. Gold was undervalued compared to its GDP equivalent price and interest rate correlated price. But after 2001, as China's and the world's GDP surged and the U.S. adopted loose monetary policies to fund the war on terror, gold prices strengthened. Finally, it's important to note that the equivalent gold price models are based on the assumption that the global economy reacts efficiently to market conditions. Economic growth and the expansion of capital eventually reflect in prices. In The Wealth of Nations, 1776, Adam Smith spoke of the invisible hand guiding behavior in a free market economy. The cumulative effect of individual actions unconsciously shapes the direction of the economy. The participants in the gold market are diverse, ranging from individual jewelry buyers to central banks. Gold is not only a form or currency, but also a reflection of the global economy. Market participants trade based on their own understanding of economic conditions, which ultimately forms the various price trends as we see in gold. Thank you for watching. I wish you success in your investments.